Hello, everybody, and I want to thank Kamala, Peter, and Professor Bob Garratt for bringing this conference together, and thank the Caribbean Corporate Governance Institute. I believe that institutions like these really are important because we have dialogue and we can talk to each other and share and educate on topics as governance, because right now it's really important. A lot of things are happening in the world. You can just turn on the TV. We just got out of the kind of COVID pandemic. In most parts of the world, not, China's still kind of dealing with their lockdown policies, but now we're in a world where we have rising inflation, and how is that going to impact consumers, governments, and policymakers? And from where I'm going to talk about today, asset owners, sovereign funds, pension plans, endowments, all the way down to family offices and high net worth individuals. So this presentation that I'm going to give today, it's going to focus on the great wealth transfer, but I'm also going to give some context on sovereign wealth funds, because some people might not understand how sovereign wealth funds operate, what their policies are, why they were even created in the first place, because one can see that wealth funds are being now created maybe one every 3 or 4 months. So I'm going to turn on my PowerPoint right now. Let me just get this going right here and get my slideshow. I guess let's see the chat. And by the way, feel free to chat if you want to have questions. Keep this thing kind of open. So I'm going to go to my next slide here. Oh, my first slide is great wealth transfer, sovereign wealth funds, pensions, and long-term asset owners. I'm going to talk about there's 3 kind of groups that our team has seen in terms of the great wealth transfer. One are sovereign wealth funds, and that's about a $9 trillion investor class. And they range from, $1 trillion plus entities all the way down to, $400 million government account at a central bank. We also are looking at the pension and retirement fund market, which is quite substantial. It's still large, divided into public pension plans, corporate pension plans, labor Taft-Hartley plans. And, but however, I do want to caveat though, with the great wealth transfer, is that many of these defined benefit plans have been de-risking. And we all know the reason why, because it's the onset of defined contribution. So the defined benefit plans are changing into more defined contributions, and the traditional corporate defined benefit plans are de-risking. They aren't allocating as much to private equity, real estate funds, infra funds as usual, and aiming more towards more liquid funds, while selling pension risk transferring to large insurance companies. So that's a huge change there. But that big shift will, in terms of the growth, is going to be in the defined contribution market. And the third bucket is the family trusts, high net worth realm. These are the family offices or wealthy CEOs and their children. Many of these CEOs are in their 60s, 70s, 80s, and they're going to be handing down lots and lots of money to this not newer generation of people that are in their 30s and 40s right now. And so that is the great wealth transfer. And what Peter was alluding to earlier is that they have been leading the front on the impact investing side. A lot of the family offices, for example, Builder's Vision, which is the family office of Lucas Walton, one of the Walton heirs of the Walmart family. He has been going big on food investments, new ways of urban farming, alternative proteins, all these sorts of interesting ways of impact investing. So from the bottom up, there is a family offices, and then from the top down, you're seeing a lot of the Canadian, European pension plans that are playing a major role in the energy transition plan of the the Climate Paris Change Agreement, right? That framework has pretty much aligned many of the asset owners, both on pensions, sovereign funds, and even endowments to a standpoint, to start looking at ways where they could invest into green assets. And right, greenwashing is a real thing. You can just look on LinkedIn and you can look at almost every post, and everyone's posting how green they are. But let's see, what capital's actually doing. And from that standpoint, yes, there is capital going into renewables, going into green hydrogen. So you're taking existing fossil fuel, facilities, and you're trying to maximize and have them more sustainable. Also, that's also happening in metals and mining, especially right now as we enter a commodities super cycle in the world of rising inflation. And to a point here, the U.S. millennial group, I know it's on the Caribbean, but the U.S. millennial group is one of the biggest population booms out there. And it's only growing every year. And they will be the next big buyers of goods, services, and investments. And that could also be said also with the Caribbean too. And in some parts of South America, there is quite a population boom in this cohort group as well. However, other parts of the world, the population has actually shrunk. If we look at the East Asian nations, the millennial group isn't as big as the US group and it hasn't grown as fast. So they kind of curtailed their population sizes. And so they're more in a different mode of saving. And I'm going to try to highlight some of those things here. Let me go to the next slide here. So the different types of sovereign wealth fund vehicles. Obviously, well, sovereign investment vehicles. Obviously, there's sovereign wealth funds that you see, Qatar Investment Authority, Abu Dhabi Investment Authority, the Trinidad and Tobago Heritage Stabilization Fund. Those are all sovereign wealth funds, right? These are state-owned funds, and they have some sort of source other than pension contributions, right? It could be a natural resource like oil and gas. It could be copper. It could be diamonds, or it could be an export surplus, as you will see in many of the East Asian nations. Then we have public pension funds, and also you can group into the corporate pension plans as well. And these public pension plans, obviously, they get their money from contributions from the employer and an employee. Then we have state-owned enterprises, and these are basically state companies, very common in many different types of economies. Every country pretty much has one, even the United States. The Caribbean has them. The Latin American nations have them. So these are basically, and some parts of the state-owned enterprises have investment arms. So Saudi Aramco, Saudi Aramco Ventures. We have Petrobras in Brazil, Petronas in Malaysia. So those are like national oil companies, and they have investment arms as well. And then we have sovereign wealth enterprises, are basically the subsidiaries of sovereign wealth funds. Sometimes you might not even know that you're dealing with a sovereign wealth fund, but it's actually owned by a sovereign wealth fund. So it's kind of the next tab here. And for those who do not know what a sovereign wealth fund is, this is the definition we've had for about a decade. The IMF definitions are very similar. A sovereign wealth fund is a state-owned investment fund or entity that is commonly established for balance of payment surpluses, official foreign currency operations, the proceeds of privatizations, governmental transfer payments, fiscal surpluses, and or receipts resulting from resource exports. The definition of sovereign wealth fund excludes, among other things, foreign currency reserve assets held by monetary authorities for the traditional balance of payment or monetary policy purposes, state-owned enterprises in the traditional sense, government employee pension funds funded by employee or employer contributions, or assets managed for the benefit of individuals. So for example, there are some entities that are managed by the emir or king or queen of a certain country, and those are the personal assets of them, but they're not sovereign wealth funds. You might also have, CalPERS is not a sovereign wealth fund. APG Asset Management is not a sovereign wealth fund. And so there's this kind of definition pool of what is and what isn't. And we'll go into more detail there, but just want to give you the basic definition. Classification of sovereign wealth funds. So in this sense, we're looking at 5 main types. Now, many academics and think tanks slice and dice, how to categorize sovereign wealth funds or pension plans or whatnot. We find these ones quite useful. So there's a stabilization fund, savings for future and generations fund, pension reserve funds, reserve investment funds, and strategic development sovereign wealth funds. So we'll go into more detail of each of these types. And in this region, in the Caribbean region, we have stabilization funds, right? Because we have a lot of oil and gas in some of these island nations and some natural resources. Like in the Bahamas, they're doing some drilling there or some exploration, and they're figuring out how to create that into a long-term pool of capital to benefit the citizens of that country. But first, the usual step is creating a stabilization fund, right? Because you have to make sure that your books are in order and you're able to stabilize a fiscal budget. Another way of looking at it is based on their investments. You know, what are their liabilities, right? If you talk to an actuary or a pension consultant or something like that, they always look at what are the liabilities? What do we have to pay for the future, right? So if we're looking down the ladder here, you have central bank or monetary authority. Their number one goal is capital preservation. However, when we saw the past 2 or 3 decades of quantitative easing, lower interest rates, the great moderation, all these trends of easy money, central banks became a lot more risk taking. They bought stocks. You know, the Swiss National Bank, they're major holders of equities. They own Apple stock, a lot of the tech stocks, Netflix out there, because they have to maintain some level of, right, you're gonna put all your money in government bonds, you're gonna be really hurting right now. The US Treasuries actually had their worst, from year to date, US Treasuries had their worst returns, I believe, since 1786. I mean, that's pretty bad. So so that's why the monetary authorities have been going a lot further along the risk spectrum. And talking about the whole green ESG movement, the BIS, the Bank for International Settlements, has been coordinating with other countries on making green bonds. And so we're seeing a lot more green bonds being issued. Therefore, it's creating more supply. Therefore, central banks can actually purchase them. So there is a greenery of the central bank system. Next point are the liquidity sovereign investors. So this is where they care more about liquidity over return. They still want returns, but they're a little more cautious. Then we have the liability sovereign investor. Then we have the strategic development sovereign wealth funds. So these are the sovereign wealth funds. And important note here, some of these sovereign wealth funds that are created, they have 3 funds, not just 1, but 3. And one might have a savings fund, one might have a stabilization fund, and one might have like an infrastructure fund. So, and I'll go to that in more detail, but just to kind of show you that an SDSWF, meaning that it's not just about the commercial returns. How can this sovereign wealth fund create jobs, help out the economy, right? So you see that a lot in the Middle East. They've done a phenomenal job with that, with Mubadala and a lot of these SDSWFs, where they ink deals with large corporations, asset managers, and they're able to bring jobs, bring talent, and then create a lot of synergies to not just earn returns, but grow the portfolio. One example of that would be the Public Investment Fund of Saudi Arabia, right? They put a lot of money into Lucid Motor, which is, remember the whole funding secured by Elon Musk, right? PF was going to buy Tesla, but that never really happened. Instead, they actually backed Lucid Motor. And with that, these are the EV cars. They went public versus a SPAC transaction. But guess what happened? The Saudi Arabian government just ordered 100,000 cars from Lucid Motor, right? So it's kind of a strategic thing where they own the company. Now the government's buying from them. I mean, that's going to improve the value of that investment. And then we have the intergenerational sovereign investor. Now, when we think of these ones, this is the Abu Dhabi Investment Authority. This is the Norway Sovereign Wealth. This one, they are going out there and they have enough cash for their fiscal budget, but now they can take that surplus money and risk it and get return and grow the pool. And these are the large sovereign wealth funds that you see in our rankings, right? Like the top 25, where they're really able to grow this out there. Let's move on here. And to show you some examples of these sovereign investors, we have the central bank, like obviously you know what those are. We have the liquidity sovereign investors, liability sovereign investors, strategic development sovereign wealth funds, and the intergenerational ones. Now we're looking at multi-models. So basically, as I alluded to earlier, that there are some where they combine them. And this is very advantageous, I think, for emerging market economies, because sometimes there's multiple goals that must be met. So first off, if your country's fiscal budget is always in deficit and you're worried about that, and that's a very big concern, especially for smaller economies, it's important to have a strong fiscal surplus in that aspect. It's going to improve one country's credit rating, therefore debt will be cheaper. It's just a multi-pronged benefit. So countries like Nigeria, they decided to create a stabilization fund. So some money will go to help the budget, a future generations fund where they can go out and try to earn an excess return, whether, awarding to fund managers. And then they had a big need, which was infrastructure, because a lot of Africa and parts of Africa, there's roads that are just dirt. So That was a big concern. So that it's kind of acting like an arm to fund those projects while bringing in third-party investors. Then you have the Saudi Public Investment Fund. They have 6 silos, right? They have their overseas arm. They have the Saudi Aramco Holdings. They're building a city called NEOM, this AI futuristic city, right? So they have, it's much more complex. And then you have like, Kuwait Investment Authority. You have the Future Generations Fund, and then you have this, Operational Stabilization Fund, okay? Going along here. And I'm going to talk about, if I have time, the Guyana and the Trinidad Fund as well, how that brings up to the, context there. And the reason why I bring up the SWSF is I think it's going to play a very important role in the Great Wealth Transfer for the Caribbean region, because there's multiple goals that I believe, and experts believe that, should be applied, right? Because one goal is creating jobs for the next generation, right? So this is why this type of fund might be very useful, because it not only can one get fiscal returns, but also the benefit of stabilizing employment and stabilizing the economy. So the SDSWF is a sovereign wealth fund that can be utilized to promote national economic or development goals. It is commonly accepted that most sovereign funds have a commercial objective guarantee, which is to earn a positive risk-adjusted return on the pool of assets. These are some sovereign wealth funds that are known to promote national or economic development goals. Now, these are some of the scenarios that our team has over the years have categorized. There's the domestic stabilizer scenario. Sovereign wealth fund invests in a domestic asset or domestic firm to stabilize and aggregate asset pricing, create domestic jobs, or prevent entity insolvency. So there are some good examples of this, or there's some bad examples of this. One example would be, let's say, for example, if a sovereign wealth fund came in and they were able to invest in tourism and bring in third-party investors, and that grew the tourist industry, let's say for hotels and resorts, and that brought in money for the home country, and that brought a return for the investor. That would be an excellent domestic stabilizer scenario. There are some bad examples, not created by a sovereign wealth fund, but there's one story that a private equity firm went in, I believe it was, well, actually, I don't want to say it because I might get the name wrong, but they invested in a refinery plant in the Caribbean, and it did not go so well. One can read a story about that. It's a widely written story, but that was not a good domestic stabilizer scenario. So there's some of them that could work out quite well, and I think real estate, hospitality, those are low touch, easy to do. If you're going to get into energy refinery, just know the history and know the risks there. And there's other types of manufacturing or areas that the Caribbean has to offer.
Shit.
What? Oh yeah. Okay. Let me go on here. Yes, and then we have the industry job creator, scenario here, and that's sort of where opens up a factory operation. If you want to increase the exports of a certain country, this is very plausible. Mubadala Investment Company, it's the Abu Dhabi Sovereign Wealth Fund. They bought into AMD and they made global foundries. It became a chip, a huge semiconductor player. Now it's listed, right? So that could be something for the Caribbean as well. One could invest in, there's a lot of alcohol and rum production in the Caribbean. Centauri Group, the huge Japanese conglomerate, invested a lot in many of these countries. So these are examples where wealth funds and pension plans and other long-term pools can partner either with a private equity firm or another asset manager or infra firm to create sort of job scenarios here. So that's another possibility. Then we have the corporate alliance scenario. Again, that's more of a corporate one where you identify like a corporation, and it's more like a reseller kind of distribution deal. Let's go, let's see here. And then the resource transfer scenario. Okay, this is more getting into metals and mining and resources. This is really common in Africa and in Latin America right now, where they take a direct stake in firm A. Firm A controls resources in which a wealth fund will need for economic and development purposes. There's also something where we see in food, right? Food scarcity is a major issue right now. We just saw that India is banning wheat exports. They're the second biggest wheat producer in the world. And then we have the Russian invasion of Ukraine. Ukraine is the breadbasket of Europe. That's what they always kind of said, right? In all the textbooks. And Russia's also a major ag giant as well. So Food is a huge national security issue. Wealth funds have already created subunits and state-owned enterprises to address this decades ago, to secure meat, wheat, soybeans, all these sorts of important food inputs. And if you look at, there's a UN food price index. I forgot the exact name of it. And if you look at the real price of food, the real cost of the food basket index, it's gone up tremendously. So this is a huge national security issue. It will create political and civil unrest. You can look at Sri Lanka right now, and it might get worse as the inflation hits and the dollar becomes harder to get in some of these emerging markets. So that this all kind of ties together, and it will impact the great wealth transfer, because if rising costs go up, then therefore there is less buying power for the next generation. Just looking at sovereign wealth funds, not a complete list. Just basically these are the kings and queens. They're the largest ones out there, about $9.9 trillion. It was a little higher earlier on, but the market went down a little bit. But you can see some of the big players out there: Norway, China. China actually, it's actually about $330 billion. Most of that's actually some of their financial institutions. And then you kind of go down the list here, and you see that there's just lots of pools of money, and you can see how it just grew over a period of time. And then if we're going to focus on LATAM and the Caribbean region, you have the Chilean funds, and then you have the Heritage Stabilization Fund. I think we need to update those numbers. It might be a little bit old, but it kind of hovers between the 5 and 6 range on their sovereign wealth fund. It was really depleted, but now it's kind of getting back up due to the price of oil. So a lot of the oil-based sovereign wealth funds are actually kind of reversing track. They're actually doing better now, and they're more gregarious and being more opportunistic. In 2014, remember the oil went down to $20 a barrel. There was a lot of panic. So those carbon stranded investors were stressed out then, and not so much right now. And then we can kind of go down the list here. And then Guyana, the Natural Resource Fund. I've been talking to the Guyana government officials for over a decade. They finally created their sovereign wealth fund and got that off the ground, about $607 million. So let's see where that ends up. And it seems like it is growing, so they pretty up. So for now, it looks like there's pretty good guardrails there. Sovereign wealth fund asset growth. Look at 1994. You probably just read them in the Wall Street Journal, saw some Middle Eastern fund name, and you're like, okay, that's great. Or GIC or Temasek. And now you look at it today, $9 trillion, just under the size of the Federal Reserve balance sheet. The size of BlackRock, right? If you add in all sovereign wealth together, it's about the size of BlackRock. So we think as an investor class, our organization, it's just going to keep growing. It's just, and it will reach, I think it'll get closer and closer to public pension plan assets as some of those plans start to de-risk, and state governments slowly will turn more of those into DC, and corporate pension plans are definitely kind of on their way there. Let's kind of scroll up here. A little older chart here. I get this one updated, but it kind of shows you the split between oil and gas and other types of sovereign wealth funds. So still, like, the majority of wealth fund wealth is still oil and gas. Now, quickly here, basis and power of these kind of sovereign wealth funds: law, fiscal law, constitutional laws passed by the Constitution, published in a national gazette, company laws and other laws and relations. And then again, I said that each one has its own purpose. So for the Caribbean region, there's lots of natural resources and money for the next generation. That's why they made wealth funds. And so there might be other Caribbean countries that are talking about it. And like I said, I mentioned earlier that the Bahamas, they have been, I don't follow it very carefully. My analyst team does, but I believe that there's some bill that might have been passed or not in the Bahamas where they're trying to make a sovereign wealth fund. So anytime there's an oil and exploration company meeting with the finance ministers of these Caribbean nations, there's definitely talks of part of that money going into a sovereign wealth fund. Thus, that money would likely to be, but it may take time. And again, first they have to find the oil and then get the permits and then extract it and make sure that the price of extraction is more profitable than the current, like, amount of barrels out there. And then again, common sovereign wealth fund objectives, just in case for those who are not familiar with sovereign wealth funds, is to protect and stabilize the budget and economy from excess volatility in revenues and exports. Very important for the Caribbean economy. And it's not just that region, but elsewhere, but just it's important to, if a lot of countries depend on oil and gas exports for their fiscal budgets, it can create a lot of stress for that nation. And then one can take that, diversify from a non-renewable commodity exports. So if you look at every Arab country, they have a Vision 2030 plan, right? It was Vision 2030. That means, how do we diversify our economy out of oil and gas, from oil and gas money? Earn greater returns than on foreign exchange reserves. Hence, you see a lot of central bank sovereign funds going beyond fixed income to more yielding assets, and then to equities, and then even to private equity, and in some cases. Increase savings for future returns and generations, assist monetary authorities to dissipate unwanted liquidity, fund social and economic development, sustainable long-term capital for target countries, political strategy, and then a lot of importance here is boost credit rating. Not talked about a lot. Fitch ratings, Moody's, they love sovereign wealth funds because it does increase and help with a credit rating of a country. It's also a bit of prestige among the nations. Hey, we have a sovereign wealth fund. We can do some business together, right? You know, we could do some MOUs, some bilateral trade opportunities. So a lot of these sovereign wealth funds do bilateral funds. Excuse me. They will invest in other countries and then create a lot of vehicles out there, and then trade and other types of modes of operation. And then again, these are always things that cycle in and out of the political and economic effects of sovereign wealth funds are transparency and investor objectives. So when we started these two back in 2008, it was the themes of the Arab nations buying the ports in America, and that, oh, transparency was a very big deal. And then the GFC happened, the global financial crisis, or every US bank wanted wealth fund money for the bailout. Remember the subprime bailout? So we all go in these cycles of globalization, deglobalization. Wealth fund money is great. We don't want their money. I think now we're entering into a phase where we are in more of a bifurcated world. And basically, some countries, I mean, look at Russia. They're pretty much out of the financial system right now. China and US, there's still a lot of tension right there. So we could see a reversal of that, and more transparency wanted by that home country. And it'll also talk about the role of state capitalism, right? You have government entities buying up stakes in companies, and that reflects corporate governance, right? Because, you know, what if you have earlier on, sovereign wealth funds did not want board seats. When they bought a large stake in a traded company, they wanted to appear neutral. They would not take a board seat, even though it was well within their rights to have a board seat. Now we have Norway Sovereign Wealth Fund. It's owned by the government of Norway. They're one of the biggest holders of stocks globally. They own, you know, a lot of the FTSE, and they do vote on proxy issues. So you actually have a state actor investing in and arguing on behalf of their interests, corporate change. Is that appropriate? One can say yes, you know, they are a shareholder, they have shareholder rights. On the other hand, they're a state-owned actor. So a lot of people, it's Norway Sovereign Wealth Fund, it's fine. What happens if it was a Russian or a Chinese state-owned enterprise that was a board member and they exercise their shareholder rights? So that's a very important thing. And the whole political, geopolitical dynamic of board seats, again, that's a whole nother topic that we can go into. Professor Bob Garratt probably can go into hours of that. But it's how the comfort of the consensus feels on accepting those kinds of things. And then going down to international economics, investment reciprocity, right? You know, we want to buy your assets, but you can't buy our assets. So it's sort of these kinds of things, and how open one country is and how closed one country is. And that pendulum just keeps on swinging, right? On how that works. Let's go on to forecasts and themes. So I forgot to update this chart here, but looking at sovereign wealth, just sovereign wealth funds, we actually track public pension data too as well, but just want to touch on sovereign wealth funds. It's actually really close if we add the public pension plan data as well. You can see that, and what I mean direct investments, I'm meaning that these are bond investments and non-listed infrastructure investments. These are them going directly without a fund manager buying up infrastructure. And as you can see here, there was quite a bit of demand as world of easy money came. And then there was a little bit of a sell-off in 2018 to recycle that capital, and it spiked up into 2020. And then when COVID happened, the deals kind of slowed down a little bit. So that first part of 2020, there was a huge on-ramp. And this 2021 data is a bit old. 2021 actually is way up higher. So there is a swing back on wealth funds going into infrastructure. And when we saw I don't have the chart here from our data, there is a lot of wealth funds and pension funds going into energy assets, renewables, right? So you have these utility companies that are looking to create more greenfield projects, and wealth funds and pensions will buy them up, and they'll recycle that, and then the utilities will recycle that capital to create more and more projects. So it's actually a pretty neat system that's happening right now. And that's currently like the state that we're seeing. So we'll continue to see more renewable assets being built, especially as oil prices keep going higher. We will continue to see that among those countries. And like I said, you have lots of private and public actors in there. You also have a tremendous amount of dry powder in the private equity infrastructure space as well. All right, here are some kind of trends that we see on the sovereign wealth fund. I guess this can also be like the pension side. They're just really known as institutional investors before 2000. No one really saw them as anything. And then slowly but surely, they started amping up their acquisitions and taking bigger stakes in IPOs and in other types of transactions. And then all of a sudden, in 2007 and 2009, they were white knights. You had prime ministers, having conferences and invites, shaking hands. We will take sovereign wealth fund money, like pension plan money. We love them. Please come. And then this is a bit old here, 2018 and beyond. I think the 2017 trend of wealth fund money is still acceptable. However, some countries' wealth fund and state-owned asset money will be scrutinized, especially depending on the geopolitical alliances out there. And that's a whole nother topic of discussion. I don't know, some more notes on how this would apply to the Caribbean region too. I think the term was Dutch disease, is the negative impact of an economy. That gives rise to a sharp inflow of foreign currencies, such as the discovery of large oil reserves. It could be any kind of natural resource, really. So the Netherlands got hit really bad with this. The currency inflows lead to currency appreciation, making the country's other products less price competitive on the export market. This is very applicable to the Caribbean. Like what you have some Caribbean nations that were heavily reliant on oil and gas. They made a bunch of money, and then boom, like what else do we do? Venezuela is a huge example of this. Not, they're in South America, but they were a very wealthy economy. Tremendous wealth in Venezuela, 50s and 60s and 70s. And then the country got kind of nationalized, and then they didn't manage their oil, they didn't manage their economy that well, and now it's, it's pretty bad. And then, it was coined by the economist in 1977, decline of manufacturing in the Netherlands. There's a lot of academic white papers on this topic one can read, and they'll go into detail and give you the calculations on why this kind of happened. I'm gonna kind of skip through this right here. And then non-commodity funds, this is more about the Asian, types of funds. Now, when any country makes a sovereign wealth fund, when I talk to policymakers, members of parliament, politicians, people of power that can make this stuff happen, they always say, we want a Norway sovereign wealth fund. Like, we want to be just like, we want $1 trillion, right? It takes a long time to get there. But how it happened was Norway actually first developed their oil industry. No one talks about this that much. They actually reinvested their money to develop and maximize the output of the North Sea oil. So Statoil, now it's called Equinor, because it's, even the most business is still oil and gas, Equinor, equality. Statoil, state oil, that was able to get money from the Norwegian government and grow their whole oil industry. And then in 1990 was the transition. Well, now we have all this capital, let's start buying up, let's start investing it. So that's when they went into bonds. And then by the 2000s, they went into equities. Now they were smart in the aspect where they didn't take a lot of money out of it, right? They didn't, it was only, they had a very strict rule. So With that being said, it grew from, $1 billion to $1 trillion plus today in over 20 years. That's a tremendous story. And so that can happen if there are tight guardrails and if politicians in those countries are somewhat consistent on their belief of protecting that wealth. There are other stories where you have the Alberta Heritage Fund. It just never grew beyond 20 billion Canadian dollars. Or you have funds that just went kaput, right? Or they were used to bail out, like the Ireland National Pension Reserve Fund, ended up bailing out a bunch of Irish banks. And now it's some sort of strategic fund that invests in local Irish companies. So things can happen when a huge crisis happens. So that's just a little case study there. I'm going to more details. Yes, and oil was discovered in the North Sea, and then again, that's when it really happened, right? And then 1990, the Parliament passed the Government Pension Petroleum Act, and you can see Norway's sovereign wealth fund, 1996 to that. So that's if one can get to that level. And again, I think the Caribbean has some potential if they can put tight guardrails in there and a good corporate governance system. One can grow that. And then asset allocation of the fund over a period of time. This is all from our database that we have. Now let's talk about, let's hone in on the region here. Let's see how much time I have. Okay, we have the Heritage and Stabilization Fund in Trinidad and Tobago, created in March 2007. So great timing because everything was cheap or was getting high and then it's dropped. And before that, they had the Interim Revenue Stabilization Fund. So it's a very liquid vehicle, right? You're buying treasuries and government bonds and those kinds of things. So the HSF was created, and then that money got pushed over there. Then and then how that money is managed. So most of these sovereign wealth funds that we're seeing now, and from this model and the Norway model, is that the policy of that sovereign wealth fund is set by the Ministry of Finance. So there's a political component, right? The MP, the members of parliament have some sort of say on the policy of that wealth. And that's why it's important, because if politics change, they could plunder that sovereign wealth fund. And so that would impact the wealth transfer. And then the central bank is more of the operator of those assets. They are the custodial bank. They are taking those assets in and they're investing it, whether hiring fund managers or we start building out internal staff. Like Norway has a ton of employees that will manage that money directly, whether bonds, stocks, or infrastructure. So it just depends on how that wealth fund is being structured. But that's typically how it is. And we think in March about $5.6 trillion. So the Heritage and Stabilization Fund, it's kind of just been in this influx mode here. Then we have the Guyana Natural Resource Fund. This is the relatively new one. And look, already $54 million in March 2020 at the doldrums or at the onset of the COVID-19 pandemic lockdowns. And then already by 2021, a pool of $607 million. So if I was a fund manager, I would be making a flight down to Georgetown. So the fund as a public fund is managed by the Bank of Guyana. Hopefully I'm saying it right, first forget. And so this is also a potential for them to really grow. And if this growth continues and they're able to keep growing it, I mean, it could go on a path of tremendous wealth without, plundering it, So that's also a whole, possibility there. And just to kind of give you this very recently, and by the way, feel free to ask questions because I think I'm approaching my time here, about 10 minutes left. I can keep going and talking about this stuff all day long, but if you have questions, please enter in the chat and I'm happy to answer them as well, or just call yourself out. But I'll just keep talking on the slide right here. So in 2015, Guyana's first commercial petroleum discovery was announced by ExxonMobil, the operator of a large offshore block. And then they had their first oil target by 2020. And before that, they floated the Natural Resource Fund Act of 2019 to manage that resource pool of money. And again, they did that because they wanted to, make sure that the volatility of that oil revenue did not lead to crazy public spending, right? When a policymaker sees a bunch of oil money come in, all of a sudden they have dreams and they want to start spending that money. And so that's why, it's really hard to create a sovereign wealth fund like Norway. However, though, that having that large pool of assets really benefits the citizenry of that nation. Ensure that the natural resource revenues does not lead to a loss of economic competitiveness. I am not familiar with the Guyanese economy, so I can't speak to all the different industries that they have there. Fairly transfer natural resource wealth across generations to ensure that future generations benefit from natural resource wealth, and use natural resource wealth to finance national development priorities. So if there is a huge need for that, like let's say they want a national highway system, or they need to develop their financial services system, or they want to even go and triple the size of their input of natural resource extraction, then that would be that kind of possibility there. Are there any questions so far? I have lots of slides, but I mean, does anybody have any questions on the chat box? See if I.
Nothing in the chat, Michael. I think everyone is
okay.
just fascinated so far with all this information.
All right. Well, I'm gonna the next one is, I guess we can talk about China and how it relates to the Caribbean. And this is kind of, we're going further off the track, but it is somewhat related. So the Chinese economy, in the past decade, they were very active all around the world. The One Belt, One Road initiative, right? And a lot of Chinese state-owned enterprise capital, Chinese engineering firms, and to a point, actually, the China Investment Corporation actually owns assets in the Caribbean. They own oil and gas assets down there, with, I believe, a French energy company. And so, with that being said, Chinese money is important to watch all around the. Oh, let's see. No, please go on. Special working all the time. Yes. So there's definitely a lot of stress in the Chinese market right now. They will, I think, continue to play a role in investing in markets. They are having their own great wealth transfer right now. Their demographic profile is a lot older than North America and the Caribbean. And so you are seeing a bit of wealth transfer there, but they will be a bit more conservative going forward. But a decade ago, yes, they were inking deals, providing term loans, barter agreements with many of the Caribbean and Latin American nations. Now, the China Investment Corporation is a sovereign wealth fund. Like I said earlier, about $330 billion of that is overseas capital. The organization has gone through tremendous change. I actually knew the founder of the CIC and the staff the staff afterwards, but it is a different vehicle now. And then the majority of those assets are SWFI, which is basically a holding company of the stakes of Chinese banks, brokerage firms, and other types of lending firms as well. So it kind of like just stymieing growth there. Let me go over to more detail here. Originally, it was, so CSC is responsible for managing part of the foreign exchange reserve. So they weren't a resource wealth fund. It was more, trying to track those reserves. I'm gonna skip through. This is more of their asset management. I'm gonna spend more time actually on the oil and gas ones, because again, these are the wealth funds that pertain most to the Caribbean because of the natural gas. The oil and gas exports. Audi is another example where a lot of wealth funds, want to mimic. They want to have this large pool of assets. So Audi has a sort of similar story to Norway's sovereign wealth fund, but they've been a lot more aggressive on the investment side of the portfolio. So once a fund hits about, I would say, $5 billion in assets, that's when they kind of take a deep look at their asset allocation and think about how can we grow this pool of money faster because we can take more risk, okay? Because most of the countries that have these large sovereign wealth funds, they're relatively smaller countries, right? There's an inverse relationship here. The larger the country of population, the wealth funds will invest less overseas. Now, it's not a strict rule, but you can see it, right? You have Norway, about 5-6 million people, $1 trillion sovereign wealth fund. You have the United Arab Emirates, they have Adia and Mubadala, small population but huge amount of assets. Singapore, and that is a model for the Caribbean. If a few of these Caribbean nations have a really good gas or oil export that they can do, then that could be a possible route for those countries. If they can grow that output fast enough, and the price of oil remains at this level, there's a tremendous amount of wealth that could be created and saved. And once you get to that point of $5 billion, $10 billion, again, that's where the funds start exiting from equities and fixed income, and then go into real estate funds, private equity funds, and they can be longer term holders of assets. Now, that's also a factor of how much the fiscal, like what mechanism rule that the fiscal budget can take from them. Is it a 3% rule, 3% of the profits? Is it a 10% rule, a 20% rule, right? How much does the sovereign wealth fund want to fund the fiscal budget? And that is where like the sausage is made, right? So ADIA, again, is definitely a case study here. I got about 2 more minutes. I'm going to go more into ADIA, but does anyone else have any questions on wealth funds, pension plans? I know I didn't really go over pensions that well. That's more towards the end, but I can talk about that as well. Pension plans too. Pretty much how we see it from the investment standpoint. Defined benefit, the large state ones, those will still be active investors, but on the corporate side of things, a lot of de-risking. All right, I'm gonna keep going here. Just kind of show you how a very simplistic drawing of this, of how the cycle works here. Oil revenues, government budget, you have ADNOC, Abu Dhabi National Oil Company, right? You have surplus and deficit. So it's kind of this stream of how things are being funded here. I mean, we can make it quite complicated, or you can make it relatively simple. I've seen countries that have it so complicated, but I think simplicity works a lot, and it's easy for the citizens to understand that. And then there's some more notes on that one. Some of their money managed there, how they pick their managers. And I guess, all right, well, time's up. I have about 4 or 5 more investors to kind of go through, but time's up here. I thank you everybody for listening to my talk. I hope it was informative. I hope you got some knowledge from it on sovereign funds, the Great Wealth Transfer. I try to mix the 2 topics together, but I want to thank the Corporate Governance Institute for giving me an opportunity to share my knowledge with you. I'm going to pass the baton over to Kamala. All right, well, thank you very much.
Thank you, Michael. Before you go, though, I did have a question. So if you don't mind, I would like to engage you for 2 more minutes. And that is to ask, do you find that these sovereign wealth funds are serving the purpose for which they were created?
Oh, can you repeat that again? 1 second. I didn't hear the last bit.
Sure, that's all right. Do you think that these funds, the sovereign wealth funds, are serving the purpose for which they were created?
That's a very deep question, and for some countries, yes. For many countries, no. And that's why corporate governance is very important, and that's on the public side of things, and what policies and mechanisms are in place to make the wealth fund insulated from the day-to-day political realm, because it could be a big cookie jar, right? At the same time, also on the other end, it could also be mismanaged if it's too independent from the government and not accountable to the people of that nation. So yes, I would say, unfortunately, many of these wealth funds, they haven't been their true purpose, but the ones that you see over $1 trillion, you know, they kind of stuck by the rules. So that's a lesson to be learned.
Margaret, can you please keep your mic muted? Just one more thing, Michael, because it's just really fascinating how some of the funds are doing so well. So I wanted to know, you spoke about Norway being the one that everyone wants to be like, and of course you did speak that one, you know, is way over the $1 trillion mark. So what would be your advice? So you mentioned setting the right policies and frameworks around managing the fund, but you know, if you were to advise, what maybe 1 or 2 things that you would say to fund managers that you need to look at in terms of growing your fund? And I take the first bit of advice you had given already, which is don't expect overnight success, because as you said, with Norway, that's years in the making. So what would you advise?
Slow and steady wins the race. So absolutely, from the mechanism side, tight corporate controls, great corporate governance, lowering the mechanism of fund transfers to the fiscal budget, and then maximizing the oil or energy export that you can, because that will facilitate faster growth. That's Norway's playbook. And then manage that money in a prudent fashion, and being patient, because it takes a lot of time to compound that wealth. But I mean, some of us are finance people here. It's a law of numbers. It's the power of compounding, right? And so you can create a tremendous amount of wealth if properly managed. But just, keep the extraction rule at a fixed number. And that's what Norway did, 3% rule. And so they're able to grow that pool of money very fast. And once it gets going, it's the power of compounding. And over time, the oil and gas needs are less, and then the investment return needs are big. I mean, and so that is where the magic is made. And so I think it's very exciting if the Caribbean nations, if they do really want to alter the Trinidad fund, or if they want to create a new sovereign wealth fund, there's an amazing possibility there. And that's why I'm just very excited. I think people should be very excited if that's a path that they want to take.
I thought some of the takeaways you were sharing just now was really good in terms of what persons can do. So I want to just ask in terms of two things. One, are there any examples of sovereign wealth funds that are set up by multiple nations? So for instance, we have several countries within the Caribbean. So, is that a thing that you can have several countries together developing a common fund? So that's one question. And the other is in terms of the management of these funds. Is there a formula in terms of, let's say, for instance, the mix of persons who are there to manage the funds? So, what would you advise?
Okay, so the first question is there a chance for multilateral funds? Or yes, it's a very, already we have in other countries, even in the GCC region. So the GCC region could be a good actually model for this. They have many multilateral development institutions, and there are already in the Caribbean too. But the GCC has done a very good job creating these development financial institutions, whether they're funds or banks, that can do that. So you could have a economic pact with a few of the nations that are maybe oil exporting, and each one puts in a dividend into a fund, and that fund could be managed to either invest overseas for the future generations, and then divide a portion of that into a what I would call the SDSWF. So a fund that could, let's say, if you wanted to invest in a lot of renewable wind and not wind, but solar, and then that would create jobs, and that at the same time as they can get a return, or they can package those investments and sell them to a larger sovereign wealth fund or pension plan and make a fat return on that. That could also be another scenario too. So yes, there is, if someone would want to coalesce those groups together and then agree to that. So there could be their own individual nations, or it could be again some kind of dividend. But there are case studies of that all around the world. They have, again, multi-countries. On your second point, on the management of an entity like this, yes, one can decide. Like the most common path that we see is it's a small team of one or two people at a bank, and they're buying bonds and doing that stuff. And over time, they will increase the internal staff, and they'll start allocating to managers. These are traditional managers that you probably would recognize, but over time, what countries like Singapore, Hong Kong did, and even Abu Dhabi and Doha, not countries, but CTAs, is that they would say, all right, well, if you want to get a manager mandate here in this country, let's have UBS or firm X or firm Y, have an office here and help build our financial services system in our home country. And so that's what East Asia and Singapore did. And then the Middle East tried to kind of do that in the 2000s. But that really helped jumpstart a whole financial services industry. And so again, those could also be ways where they can kind of play a role there. But going back to your main question is, yes, it evolves. And then over time, You know, Audia, I believe, has over 1,600 employees now. It can be quite a substantial organization if you want to manage it internally. And then that would save you on manager fees and all that kind of stuff. But then it comes the question is, how do you find people to hire? But there's no doubt in my mind, people would love to relocate to the Caribbean, the beautiful weather down there, versus I know I have my colleagues at the Alaska Permanent Fund, and they have a hard time recruiting in Juneau, Alaska. So, you know, I'm sure a lot of people would love to come down to the Caymans or to the Bahamas or to the Trinidad and Tobago and you know, operate out of there. But yes, it's yeah. So it's very exciting. Like I said earlier, is that if those proper guardrails could be implemented.
And so you have said that this is like, you know, a great time for that. Are there particular factors that you would say supports setting up sovereign wealth funds now? Are there driving forces that are making it so feasible?
I think the rise in the price of commodities and oil and gas, this is a great time to do it and to take that revenue and be contrarian and just, you know, be able to, yeah, I mean, in times of crises, there's also great times of making money for your people. And so, yes, this would be a great time for a country to either rejig its asset allocation or also, that's my personal advice, or develop a sovereign wealth fund to do those things. And really, like I said, if the proper things are there, it'll pay off in 20, 30 years. You will, I mean, look at Norway. I just showed you that chart of, you know, not that much money. And now, in case Norway has a huge recession or something, they can tap that money. But here's the thing, I mean, this is a great model because many of the Caribbean nations, they're small populations. They're not, you're not talking about a country of 50, 60, 70 million people. You can do this. It can be achieved. I think if you run a big country like the United States or Brazil or Russia or China, it's hard to make a sovereign wealth fund because there's so many competing factions and there's so many, you know, different needs for it. And it's wealth per capita, right? I mean, look at Norway Sovereign Wealth Fund divided by a person. That's a lot of money per person, right? So it is achievable in these island nations, Singapore, and these are all kind of laboratories of how, you know, countries can be successful in terms of economics. So yes, I think there's no greater time than now. But yeah, I mean, it's definitely like a time where the rising price of oil is amazing, and also that money could be funded to increase the output of that oil and gas. So you could increase that supply and then have more inflows coming in. And that's again what Norway, the UAE, all the countries did the exact same thing. So there's already a blueprint for that.
Excellent. Thank you so much. So are there any questions or comments from anyone? If not, then I want to thank Michael. I find this was such a fascinating presentation, Michael. As you can see from my questions, we will definitely want to have you back so that we can explore this in greater detail, you know, to ensure that there's clarity of understanding of these opportunities that just waiting for persons who are willing to develop the knowledge and the understanding and take the risk to set up for long-term future success. Yeah.
Absolutely. Well, thank you, Kamala.